Hi, hello everyone. Welcome to ICM Academy. My name is Sai Mahesh. I'd like to thank you for joining today. All right, today the topic could be like learn more about FX risk management strategy. So before we begin, let's uh, give some informations all the opinions, analysis, news, and information mentioned in this webinar only serve for education purpose and should not be taken as a signal whether to buy or to sell a certain financial instruments. So ICM does not provide any investment advice. All right, so good to see. Let's, as you know, before beginning the topic, so we can have we can start with a small introduction about ICM. Like later, we're going to jump into the main topic today, the risk management, money management. Right. So basically, ICM like established in 2009 in UK, and we have multiple regulations globally, and which offers many services like 5,000 plus investment instruments like civil liability insurance for your trading account, uh, award-winning platforms like MT4, MT5, C-Trader, ICM Securities, like fast executions on funding, like deposit and withdrawals. More for like we have MAM accounts, affiliated program, as well as we have white labeling. And you have a dedicated account manager to help you to support for 24/5 and also like executions, competitive spreads, and a good liquidity like providers. So the board like to inform more and more informations like this webinar will be recorded and later you can have it will be uploaded on the YouTube. So you can also have a refer on to this. And in case of any doubts at the end of the webinar, we can have write your questions and I'll have tried to help you out your questions to answer it. And moreover, like you'd like to get more suggestions or feedbacks, you can always write to our email, webinar@icm.com. All right, it's just we'll get into the thing like this is. So first, I want to get into the trading style. So maybe have a question that today's topic is risk management. Why we want to get into the trading style? Obviously, it's very important because any risk management, it's all involved with your trading style because it depends on your time spent, depends on your risk factors, depends on how much risk you are going to take on your account. So it's all depends on the trading type of traders. So you can see the major four types style of traders here in this scalper, day trader, swing trader, and pushing traders. This is among the four, like mostly comes around within this trader, basically. So when you're talking about scalper, so scalping is a style. It's basically a trading style which includes very intensive and quick trading. So scalp traders looks to open and close a trade within a minute. Within a few seconds, 30 seconds, within a minute, they try to close the positions. Often they take advantage on small price movements. Also, like scalper is also like they register small profits. You know, they try to take small profits while exposing trading accounts to a very limited risk, not much risk as well as much profits. They try to come into the market in and out in a very fastest way in a very shorter period of times. So this is all about scalpers. So next is a day trader. So probably most of the traders will be like to have this trading kind because it's within the day. So day trading styles are acting as a speculator by buy and sell and prefer to open and close the trades on the same day itself. Like they try to open few hours before and try to close it in the same day. So day trader is a short-term trading style, which basically because it is implements analysis of charts within some small time frames, you know, like 15 minutes, 30 minutes, or 1 hour. A day trader usually spends like maybe you can say 3 to 5 to 6 hours or something per day of a trading. These traders like rely on mostly on technical analysis because they try to do some analysis on indicators and all stuff and taking some small price movements and trading with the high liquidity currencies, like for example, major pairs. This gives a lot of momentum movements on the markets, ups and downs. So in order to take some profits. So next is the swing trader. So swing trading style is that focus on price short-term momentum, which continues typically for a week, even more based on the time span. So basically, what I'm trying to say that swing traders are considered to be a medium term as positions are generally held. So anywhere between like a few hours to few days also sometimes. They used to trade in a higher time frame, for example, like more than an hour or more than like 2 hours charge or 3 hours charge, something like that. Because the time management, this is quite minimal compared to the last two, because it's which is suitable for the trader in a short of time. So opening the orders and closing the orders should be like in a certain price level they try to reach, and they try to trade on that particular point of time. But basically the time spent as well as the risk factors involved in it. So we're going to cover all those points in the coming slides. The final one is a position trader. The traders utilize the longest time frame of trading, lasting for several weeks and months. So obviously, like this is suitable for the trader looking for hold the position for a prolonged time, or we can say months. We can say for years also sometimes. Often based decisions on the long term. So this trader usually prefer to use some fundamental informations analysis, fundamental analysis, like a macroeconomic, political, and other, even there are technical indicators also available to analyze for the long term. So when they're making the decisions. So trading style, which really a consistency in trading style is lead to a consistency in the results. So that's why I want to highlight this as initial point, like traders. So based on this, your risk factor is going to define on each method basically. So if your trading strategy sounds with a proper risk management, and sticking it to the provided desired result for you. So obviously it's very important. So now we can jump on to the main topic, which is money management versus risk. Okay, many one have a question. Maybe new beginners traders will be there, or experienced traders are there. But quite for any traders, risk management it's one of the most important tool to be in the forex trading. So what is risk management? So risk management is one of the most important topics you will never ever read about in trading. It's very, very important. So why it is important? Well, so we know that we are in the business of making money, right? Obviously, trading is completely making money out of. And in order to make money, we have to learn how to manage a risk. So what I mean is how to manage a potential risk, potential losses. That's most important thing. So the risk management rules will not only protect you, but you can say they can make you very profitable in a long-term run. So that's the major point we have to focus on this, because trading, like you can trade for daily basis, you can trade for weekly basis, but being there in the market and being there for the long time, that's the most important. So if you learn how to control the losses, and you will have a chance of being profitable. So at this risk management, it's a very essential aspects in forex trading that can mean the difference between the success and the failure. So risk manager define the success and the failures. So basically, so in this webinar, we will explore the various methods and techniques that traders can use to manage risk and protect the capital while participating in this forex markets, right? So just keep following the upcoming slides to be success, and make sure that you get some knowledge out of it. All right, now we can move on to the money management and risk. So in money management, it's one of the key concepts of long-term success in financial markets. So it helps to manage your trading risks. So I highlighted some few methods here. So for example, like take from a risk to reward ratio method, percentage risk method, scaling into trade, use of stop loss and limits, choose a proper leverage, and regular checking in trading journals. So these are the few highlighting methods to be monitored when you're going for the trade. So let's begin one by one, and I'll go in a basic way to understand yourself because it's a very important topic. Probably like everyone has to be come across the in case in losses when they will go for a trade. So obviously this is you can pick up like some kind of information and it can quite useful for you, to start up the trading zone. All right, let's start with the risk and reward ratio. Risk reward. So you can form the word, we can say that the risk, it's worst reward. So fundamentally, the idea of trading in this market is a relation between the risk and the reward. So there is no risk, there's no reward, there's no return. So obviously, risk is involved in any trading. So greater the amount of risk that the investor is willing to take, the greater the potential returns and vice versa. So obviously, if you have a lesser risk, you will make higher returns. When you make higher risk, you make a lesser. So it depends how you choose yourself as based on your capability of taking risk. The reason of this is that the investor need to compensate for taking additional risk. So it depends on the risk factors for each and every define on that. To mainly, it's a kind of ratios works on this method. It's very easy methods, nothing to be complicated or nothing to be calculating or very way to understand this thing. So it works on ratios. So for example, using 1:2 or 1:3 or 1:5 risk to reward ratio. So very simple. So for example, if you have a potential you want to take it for each trade or on a trade, it's $200, and you're expecting a maximum profit gain to be like $400. So it's fine. It's $200 a risk and $400 your profits. So this reward ratio is 1:2. Same way, like if you want to trade 300 and you want to make 600 as a profit, it comes 1:3. So traders usually use these methods, especially for keep the consistency on the risk as well as to prolong the trade for the longer term. They choose some kind of support resistance of the day for placing the stop loss because it's very important because we can't like place our stop loss just like that randomly in some point. So obviously they try to choose the resistance levels and support levels for the day, which helps them to keep a point somewhere the stopping point for them to trade. Moreover, like there are traders who prefer to do more technical analysis by other kind of tools like moving average, channels, and etc. Many are there for them. So based on that technical things, and they try to keep their risk ratio on the point and keeping on as per their capacity of risk, they try to move on with 1:2, 1:3, and 1:5 based on that. This is what exactly. So to find your ratio, like what kind of ratio, compare your amount of money you are risking on a trading account of a potential gain. That's most important because risk return trade-off, you must be aware of your personal risk tolerance when you're choosing investment for your portfolio. That's most important. Choosing the product, choosing the amount, as well as choosing the risk and which kind of ratio you're trying to do that. So taking some risk in the price of achieving returns. Therefore, if you want to make money, you can have to be on cut you all in the risk in this. So remember that whenever you trade with a good risk to reward ratio, your chance of being profitable are much greater, even if you have a lower win percentage. So what I mean to say, even you have a small profits on your trades, and if you have a regular kind of a risk ratio method you implemented, adapted on the trading, so definitely you will end of the day you will have a kind of a lower win percentage of profits will have. So this is all about risk and reward ratio. Quite easy and same time uh, difficult to follow sometimes because it's involved with your risk and your capital and markets movements and fluctuations, but definitely it helps a lot. Actually, it makes sense. So let's move on to the next. Well, we go for the percentage risk method. Percentage risk method is a method according to which you risk the same fraction of your account balance as a percentage per each trade. More or less same. There's no difference, much difference with the risk ratio as well as the percentage. There we're talking about a ratio format like 1:2, 1:3, 5. And here we are talking about as a percentage based on percentage of risk of per trade based on your account balance. So that's it. So calculating each position that determine the risk based on the account size. So account size is $10,000 and you're ready to take a loss of $500 in single trade, then your drawdown is 500 obviously from $10,000. So obviously it is gives you a 5% drawdown. So as a trader, a number one risk to known as the drawdowns. That's most important thing because many trader doesn't mind about that because they start trading. They don't care if they continuously they have a couple of losses on a single trade. They try to jump into the market to cover the loss in the same day, or they try to do some other kind of what I can say, averaging the positions or some stuff they try to do. But no, when you have a stick on something on a risk management, you have to follow 100%. So what I did here, I shown you a small table here. So to understand, easy way to understand. So you can follow this and you can stick on to that because that helps you like, for example, you done some 10 trades, for example, for a day or something like that. And you're following the percentage risk for each trade with 2%, or it depends on your capacity of risk. It doesn't mean you have to carry only 5% or 10%. So it depends on you like two. So what happens like when you do a number of trades, obviously your balance and your equity of your account size will be safer and safer because successful of your number of lots and failure of the lots, it depends on how you strategy you follow on there. So this is a small a table where you can see $10,000 with a 10% risk, which is $1,000. 10,000, 5%, which is $500. So 10,000 with the 2%, which is $200. So this is how exactly. To be more clear and to more deep, to give some more example, I had plotted some more information for you. So this is how exactly it works. So I take an example of 2% risk and minimum risk. Obviously, this 2% is the minimum risk which you can have to trade in any markets and on each and every trade. That's what I mean to say. So example here, I taken a major pair of Euro USD. So 2% of risk is $200 from out of $10,000 here. So each value is like $10. Everyone knows about it. Each peep of moment of Euro USD is one lot size is $10. So when I use 1:2 risk ratio, risk reward ratio, as I said that risk reward ratio 1:2 and 2% of percentage risk reward, both are same almost. We calculate the percentage wise, there you calculate as a ratio wise. Then if you keep your stop loss of 20 pips and you want to take a profit of 40, that is 1:2 ratio. So if it goes against the market goes against you, you lose $200 and you make $400 as it is. Hence, so that's what I mean to say. It's both are equal. So this all size, lot size are being based on the lot size. The risk is defined. So if you want to increase the loss like 2, 4, 5, something depends on your size, and it depends on you how you take a risk on that. So what I come to know that trying to explain the percentage risk money management implies that there should be a constant percentage of account balance that you risk per trade. That's most important thing. So in order to calculate each positions, so you could be entering like you need to have determine the risk, and you could want to expose yourself to and size of the trades. So it's fine having those like two at hand. Like you will be able to estimate where to place your protective stop. Fine. So absolutely, it's very easy. I mean, following these two methods is quite similar, like, but definitely it helps a lot on a long run. All right, let's move on to the next one. All right, it's a scaling. That's I can say, like, so one of the best and very like a popular method of interest management, because like there are high risk involved because if you miss to for not following the particular systems or rules of this scaling, because many times markets in a one side trend, upside or bullish trend or bearish trend. So traders like to try to attempt to take more profits because they like maybe they feel that I miss the profits. They book the profits and the markets keep going on the favor, but they try to I miss the profits. I try to get into the market again. let me grab some more points and some more profits. It's again like if you have a system of scaling and scale out systems in your mind, in your plan or something, it really helps you to maximize your profits, maximize the profits. That means a trend is the best friend, right? So you go along with the trend. So scaling is a method of money management, allowing you to limit your potential losses and maximizing your potential profits. So you keep increasing your profits, you keep move on your profits on a market favor, like on your favor. So scaling means gradually. So what you can say, why I should use scaling? Maybe it may comes to your mind, like, because scaling basically means very simple, adding or removing the lots from your original open positions. Very simple. So removing or adding from your open positions. So this allows to increase your profits, reduce your risk, limit your loss when the market turns against you. That's most important thing in this method, because where other two methods, you will cut out your loss from 2%, 3%, or 1 to 2, 1 is 3, something like that. But here, there are chance of you make profit, and moreover you limit your loss or maybe neutral your loss when the market's against you. So that's the best benefits and advantage of this scaling. So in the scaling, there are two types of scaling. One is scaling in and scaling out. So what is scaling in, like how it's going to help you, and what scaling out? These two are a kind of popular risk management system where it helps you basically when the market is on a one trend. If market is a consolidation, like ups 50 points, coming 50 points, okay, that's a different way of going on because the market doesn't move, but still it helps you on this scaling system. But when a market is in one side directions, we never know where the market is going to turn or going to be a continue on the same trend. This method will help a lot, which is going to be a system of maximizing your profit on that way. So scaling into a trade means opening a position with just a fraction of capital. Yeah, you initially intend to commit yourself. For example, you would try to want to take one lot or two lot. As per your exposure of your margin or leverage, you plan to take some one lot, two lot or something. Then entering into more position if a market moves in your favor. So what does mean exactly? Have planned one lot to enter in gold or maybe in pairs, currencies or commodities or equities, whatever. So now, instead of going into the market with execution of one lot, you go with a partial lots, like for example, 0.50. Or if you're planning to two lot, you go with a one lot. So when the markets goes favor to you, yeah, and there is a levels, you may have some important levels of the day, like resistance levels, support levels, or maybe you kept your levels the point as per some indicators on the technicals, on a technical analysis. So based on that, if it breaks or if it moves or breaks the break even point, it may further goes up. So where what you do, like this 0.50 other half of the lot, you're going to add it on the market. So what happens again, you are continuing with the markets with what plan you kept for the lot size, and same way, and you are with the market with a partial time frame or the partial levels of markets move, which will helps you to accumulate the profits. So scaling out, it's again like it's a similar way, but means selling a fraction of total exposure after your position has become profitable. That means when you are get into the markets and you want to hold your positions, but you come out only the partial amount from that. Remaining, you will be running with the markets along with the trading, along with the markets move, the favor of your markets move. So this is also one of the things. So these two are very, very important. Like what you can say, for example, if you're planned for going long with one standard lot, and you can enter a position by committing yourself, it's all very, very systematical things which you can follow on this risk management. So if you trade continues with those kind of standard lots and partials and looking at the profits of the partially, so this helps you to go along with the trend, which also gives a lot of comfortability. And one more thing, like when the market against you or something like that, so you can keep a stop on your first initial positions or a break even or something like that. So what happens here at the end of the trade, the end of the completing your trade of the particular trend, or maybe for the day or whatever may be, you come with your profits instead of that booking a loss. So this two, scaling and sale out, definitely it's one of the best money management. Of course, scaling in and out trade, it need a proper money management. It's need a practice. It need to be implemented slowly, gradually. You have to increase yourself. More is important the discipline, because one trade you follow, other trade you may not. So a discipline is very important in trading. Any systems, any technical systems you follow, any strategy you follow in the trading, discipline is one of the first important point to be adapted. And otherwise, you lose, and like when you're using any other strategy as well. So this is what exactly. So this is all about scaling and scale out. Let's move on to the next one. Stop loss and limits. Many traders don't like stop loss because they have had a bad experience, because they come with them like every time my stop loss hitting, like every time I trade. I agree, but same time, stop also is one of the tool which helps you, like save your balance, save your account size, because without stop loss, many traders like goes against them completely, and he may be a scalper or he may be a trade trader, and end of the day he became a position trader, and he is on against the markets. So this is all the main reason actually. But using a stop loss is like you're wearing a belt while driving. It's how safe is this, right? Same way, because stop loss is the most important thing, and especially for the beginners, especially because they come in with some expectation in the markets. Yes, market is always a potential for the profits, but at the same time, there are systems, rules, and everything to be followed. So go with stop loss and limits. So forex trading is particularly volatile. So deciding on your trades, enter and exit point is crucial before opening a position. So you can do it by using various stop loss methods out there. If you go to the features about the MT4, MT5, C trader, that's why the features are applicable for the traders. So you have to use all these kind of features to help yourself to protect from yourself, to minimize the loss or control your loss or cut your loss. So there are different kind of stops are there. Well, getting to the platform, you come to know that there's stop order, stop loss order. So that's a regular order, and you can place orders there. So these orders can also choose how based on your risk method. For example, I'm taking risk of 1:2 ratio, and I'll check nearby, like, okay, this level is that. So obviously you can use your stop. Don't keep on your mind, because no one can watch or continually watch the markets all the time 24/7. So obviously these features and order types are helps you to protect you and protect you from your major losses. So whenever you feel that, okay, I'm going with this risk management, risk money management rules. So obviously I'm taking this percentage, or I'm taking this ratio, or I'm doing this scaling system. So let me put the stop loss there. So place a stop loss and you start trading. And next one is a trading stop loss. I don't know many people are aware of this thing, but very interesting one, very interesting, because it also helps you with the scaling kind, because when markets, you have bought something or sold something and market is on your favor, for example, and you with the stop loss and market's on the favor, so where you close the partial amount of your trades. For example, you enter with one lot, the same like a scale out, but still one thing there, the stop loss remains same in scaling and scale out. But here in trailing stop loss, you can increase the stop loss. For example, you bought one place like 1,900 and the gold, and market moves to 1,910, and market moves 1,920, something like that, and you booked your partial profits. Now, from the original point which you bought, you can move the stop loss from the bottom to the neutral level. And the market keeps moving up and up and up. It's on your favor. You keep increasing your stop, like from 900 to 910, 920. So what happens here? So end of the day, you 100% comes out in the profits. So one of the best system, need practice again, and also need patience, because it's movement on the trendy markets basically. So it helps a lot and a lot. You can practice in that way. And limit orders, especially because the limit orders is the most important thing. Many traders like to keep their position just like that because market is not one side. It is a double two-side, two-way markets basically. It is given a $10 move or a $50 move in gold, and it can give $100 downside. So there are more possibilities are there in either side of the move. So grab your profit. That's most important thing. Whenever you see a profit, and especially for the retail traders or like day traders or something like, because position traders, swing traders, they have something on their mind, keeping for long term, for week or month or something yearly. But coming to the scalp or day trader especially, definitely book your profit, keep your profit limit, and try to trade on the winning limits. That's most important, because when you miss the chance of profit, and definitely is many times it's rare to reach back again to the same price. So 100% you have to use this, all the stop loss and limits. This also comes under risk because which protect your account, protect your account and protect your profits and minimize your risk. So obviously this features has to be one to be followed in risk management. All right, next, leverage. It's also like a very quite interesting topic, because many of traders a common mistake, like they're looking for high leverage because they get high exposure on the markets to take more lots with a smaller money, but they don't know that basically high leverage is high risk basically, because you're taking more lots, more positions in the markets. A small move, a small reversal move of from your open positions, it's a high risk for you. So you have to be very careful on choosing the leverage, because when the markets are favor in trade, leverage will multiple the gains. There's no doubt, no doubt. But markets cannot be one time every time on one direction. Market one a day or two something gives a trend. After that, it keeps moving on either side. And if a market moves opposite your trade, however, the loss is going to be multiple. So what happens? The loss, your accounts get burned. So it's not a mistake with the market. Market is characters, and it's characters like that. It's ups and downs. So only we have to protect ourselves by precautionary measurement to be taken. What are the way we can take out of it? Use out this kind of methods which help you really a comfortable level of this. So use adequate to control on your comfortable level of leverage. And your caution and your inexperienced investors or trader, always start with a lower leverage, because like start with a lower leverage with this risk management, with a proper strategy and plan, this will also help you gradually improvise it, because it's some difference between the beginners and there's a difference with the experienced traders, because they may have some good strategy with them, even good strategy, you have a good trading psychology, you have a bigger size of accounts, but if you don't have risk management, again, you are in a loss. You are in a downside of your account. So again, so the best leverage range, which you can start with the 1:50, 1:100, 1:200, then gradually you can keep increasing as per your performance, as per your experience on the trading platform. So the common mistakes, mainly for the new beginners, is inadequate leverage, which it's size of the based on the account size. So that's most important. So leverage plays a major role on risk management. Maybe many people does not understand why leverage comes in this point. No, it matters because the exposure, number of lots, and based on the account size. Hope you understand. All right, let's move on to the last one, which is a regular check in trading journal. Even this is also, I can say, you can mean like many of them doesn't look into these journals, obviously, because it's like a ECG checkup. You have to do it regularly, and you have to have a track record of keeping your a trading performance on a daily basis or weekly basis, something like that. So trading journal is a complete record of your trading activities over time. So access your overall performance, and also helps you with continue with the same strategy for the better performance. So if you have a very good strategy and your trading journal gives a good performance and good level of indication of your profit side, obviously you can continue with the same strategy. And if it is a poor performance, how will you come to know? You can't be everyday trading. You can't come to understand on one conclusion that there is strategy which goes, your strategy goes on against your plan. So when there's a bad strategy, obviously, or I mean, like a poor performance, obviously you need to exit from the strategy and look for the other new strategy or something like that. So the main goal of keeping this detailed trading journal is to mainly to prevent you from taking impulsive actions, which will ultimately result in saving your money. Exactly. All right. So this is all about today, and like we are have more webinars coming up with many topics, interesting topics, where we're going to cover strategy, we are going to cover trading plans, trading psychology, indicators, fundamentals, many and many going to come up with us. So if you have any doubts, you can write your questions, so I can able to help you out. And thanks to everyone. So we have 2 minutes, so you can give your questions. And moreover, if you like to get your suggestions, your feedback, always you can write it to our webinar at icm.com. Always welcome. And you can also want to get more information about this risk management topic today, what is, and need any support, and we are there to support you. That's the reason we are having this kind of webinars to our traders and investors. So you're always welcome for that. Any question, please? Well, there's one question raised. What is a preferred trading style? All right, very good question. That's every trader has to ask yourself first, because it's all based on your size of account, size of risk capability you are going to take, and third, time spent. So it depends on these 3 parameters you choose which kind of traders you want to be. If you are sit for a long time in your trading and you want to do small like scalping trading, you have enough time to do that, and you are under much time. I can spend like 3 to 5 hours in a day or something like that. Even 1 hour you can do the trading. Many traders do that. They do office work, they come back after the house, and especially in the evening time, the market has a very volatile. You can use that way. So day trading, which is also one of the suitable. But again, coming to your long term, again, long term view, long term day, patient needed. Investors, they like a long positions, then definitely choose for the other one. But I suggest you day trading is one of the best to choose, like 3 to 5 hours trading, which easily you make and you can come out. Main thing, it's not me making money. You make experience on the trading, so you learn something new and new everyday basis. So that helps you to correct your mistake, to change your strategy, and it'll give you a lot of strength to come up with a long-term plan on a regular basis. Yeah. Any questions, please? There's one more gentleman looking for raised one question. What is a more useful high or low leverage? Obviously, nice, because as a beginner, better start with a lower leverage, because they don't understand the pulse of the markets, the potential risk of the markets. So don't think about the markets like potential profits. You have to think about the other side, like risk also. As I said, like in a slide, which is leverage plays also a major role, because many traders doesn't follow that, because as a beginner, start the lower leverage and gradually increase on it. When you get experience for 1 month, 2 months, then 1:100, 1:200, and 1:2. It depends on you how much leverage you would like to take, because the higher the leverage, higher the risk. So balance yourself, control yourself, and go ahead with this. Thank you. All right. So that's for today. So hope everyone has enjoyed, and see you soon, very soon. And in case of any question, again, I'd like to give you, we can write to webinar@icm.com, and this webinar will be uploaded on our YouTube, and you can go on later, you can have a look on it. All right, that's it. Thank you. Thank you so much, everyone. See you in the next webinar. Bye-bye.